Welcome, everyone, financial modelers, risk managers, and ESG compliance officers to this explainer. Today, we are tackling one of the absolute most pressing intersections of our time, climate risk and mortgage-backed assets. We're going to get rigorous, we're going to get granular, and we're looking directly at how environmental threats translate into cold, hard financial modeling. To anchor our analysis today, we're looking straight at the SASB standards for the financial sector. As you likely know, these standards are now under the stewardship of the IFRS Foundation, which makes them the authoritative global framework for sustainability accounting. We're going to unpack exactly how this framework guides us to quantify what used to be considered unquantifiable. Okay, let's dive into this. Here's our roadmap. We'll start with the SASB mortgage standard, look at environmental property risks, and then we're going to build out our models for total expected loss, loss given default, catastrophe categorization, and finally, geographic mapping. Section 1. The SASB Mortgage Standard, Navigating the Framework. If you're managing vast portfolios, you already know the regulatory environment is shifting incredibly fast. Looking at the sustainability disclosure topics for mortgage finance, notice how the industry standard funnels down from broad lending practices directly into our core focus at the bottom, environmental risk to mortgage properties. This is exactly where physical climate reality collides directly with your balance sheet. Section 2. Environmental property risks, the baseline threat. Extreme weather is literally an existential threat to the physical real estate collateral sitting inside your portfolios. Just think about this stark baseline number, 1%. Under SASB metric FMMFA 450A.1, entities must disclose the number and value of mortgage loans in 100-year flood zones. That 1% represents the minimum annual chance of flooding. It sounds small, right? But over the life of a standard 30-year mortgage, a 1% annual risk compounds into a massive structural vulnerability. To be perfectly precise here, the standard defines 100-year flood zones as land areas subject to a 1% or greater chance of flooding in any given year. So we're talking coastal floodplains, major river floodplains, and even low-lying areas subject to ponding. This geographic reality is the absolutely crucial context we need before we step up the complexity and start calculating actual financial loss for your disclosures. All right, here's where things get highly technical. Enter metric FNMF 450A.2, calculating total expected loss and loss given default. This is the core metric of our explainer today. It's the essential requirement for quantifying, testing, and disclosing climate risk to your investors. You're no longer just counting properties in a flood zone, you are modeling the projected financial damage of weather-related catastrophes. Section 3. Modeling total expected loss, the formula. Now, what's really interesting about this is how we break down the math. Step 1. Identify the values of all possible losses for the underlying collateral. Step 2. Multiply each value by the probability of that specific loss occurring. And Step 3. Sum the results. For the advanced modelers out there, this probability-weighted average means stepping way beyond historical lookbacks. You're looking at running Monte Carlo simulations and utilizing dynamic hazard curves to model structural vulnerability against projected climate events. Section 4. Loss given default, defining the metric. Calculating that expected loss, well, that's really only part of the story. The standard strictly defines loss given default, or LGD, as the share of an asset lost in the situation of default. For the modelers tuning in, the crucial requirement here is that this LGD percentage has to be isolated to collateral depreciation caused specifically by weather-related natural catastrophes, not macroeconomic downturns, not local job losses, strictly physical weather damage. Section 5. Categorizing natural catastrophes, what to include. So the crucial point is that precision in your data inputs is everything. Feed the wrong disaster data into your models, and your LGD is fundamentally flawed. SASB explicitly groups weather-related natural catastrophes into 3 distinct categorical buckets: meteorological, hydrological, and climatological events. Your risk models must account for all 3 of these to provide an accurate, compliant picture. Let's walk through these buckets. Meteorological events include acute weather systems, hurricanes and severe storms. Hydrological events primarily refer to floods. And climatological events? Those cover broader atmospheric patterns over time. Think heat waves, cold waves, droughts, and, of course, wildfires. These are the specific, quantifiable variables you absolutely must inject into your stochastic models to calculate hazard probabilities. And this brilliantly illustrates a vital distinction for your compliance reporting. You must include weather events, but the standard explicitly excludes geophysical events, earthquakes, volcanic eruptions. While totally devastating, they just aren't driven by the climate, so they're strictly kept out of this calculation. You have to keep your weather models and your tectonic models completely segmented. Section 6. Geographic mapping, segmenting the risk. Look, a national aggregate of expected loss is basically useless because climate risk is inherently local. A wildfire in California behaves entirely differently than a hurricane in Florida, so your data has to be segmented, which raises a huge implementation challenge for compliance officers. How do you actually map this risk geographically? Do you use zip codes, counties, states, or broad climate zones? Well, the answer straight from the SASB framework might surprise you. Quote, applicable regions are determined by the entity. That's right, you have the flexibility and, honestly, the immense responsibility to define your own geographic regions for this disclosure. You have to determine exactly what level of granularity provides the most useful material information to an investor looking at your unique portfolio concentration. Ultimately, calculating these metrics isn't just some backwards-looking exercise in reporting. It leads us directly into metric FMFE 450A3, incorporating climate risk into mortgage origination and underwriting. The whole point of modeling total expected loss in LGD is to actually influence how you value collateral in the real world. It's meant to inform your credit risk analysis upfront, before the loan is ever made. Are you properly pricing in the risk of a property being uninsured or underinsured in a newly designated floodplain? Which leaves us with an absolutely critical question to consider as you head back to your data sets. If extreme weather demonstrably increases the likelihood of default due to uninsured or underinsured properties, how will these SASB metrics fundamentally rewrite your credit risk models tomorrow? The data's there, the framework is clear, now it's time to build the models. Thanks for joining me on this explainer, and keep digging into the data.